We often say saving money is a smart choice. However, there are instances when saving may not be the best strategy for you. While saving money is essential, it's not enough for accumulating wealth. While having a savings account is important for emergencies and unexpected expenses, relying solely on saving money without also investing it can limit your potential for growth. Number 6. Inflation. One of the biggest reasons for this is inflation. Over time, the purchasing power of your money will decrease if it is just sitting in a savings account earning minimal interest. Investing your money, on the other hand, can help it grow at a rate that outpaces inflation and can even provide additional streams of income. Inflation is equal to an increase in the cost of living. Based on data, the cost of living typically increases by 2% annually. This results in a rise of 2% on average for expenses like rent, utilities, groceries, and other bills. As a result, if you saved $1,000 last year, it is now worth 2% less, $980 due to inflation, and each year, the 2% reduction accumulates, causing your savings to gradually decrease. Number 5. Using savings for retirement. Your current savings may not suffice for retirement if your income is not extremely high. To secure a comfortable retirement, you must invest your savings and let them grow. Keeping savings in cash can be harmful as inflation will erode its value over time. Hence, investing in the stock market may be a better option, even if it involves taking some risks. Number 4. Magic of compounding. The power of compounding can enhance the worth of your investments. By investing in value-driven opportunities globally and using financial hedging strategies to safeguard against currency decline, you can reap the rewards of investment growth. Over a period of 10 to 20 years, compounding can significantly increase your investment capital, potentially leading to a return that is double or more than your initial investment, especially if you start early. Number 3. Fear of spending savings. Additionally, saving money can also lead to a mentality of scarcity and fear around spending. This can prevent you from making necessary investments in yourself and your business, and can even lead to feelings of guilt when you do spend money. Number 2. Long-term versus short-term. For long-term financial goals like retirement, investing your money can be a good choice as you have a longer period to weather stock market fluctuations. However, if your financial goal is short-term, such as holidays with a time frame of 5 years or less, it may not be wise to invest in the stock market. In these cases, it's better to keep the money in a high-yield savings account to avoid the risk of a major downturn that you wouldn't have enough time to recover from. The decision will also depend on your individual risk tolerance and overall financial stability. Number 1. Investing. Investing in stocks, bonds, mutual funds, or real estate, among others, can offer higher returns over a long-term period compared to the low interest rate offered by savings account. The value of your investments can go down as well as up, which means you could lose some or all of your initial investment. On the other hand, savings accounts are considered a safe and low-risk way to store money as they are insured by the government up to a certain amount. The returns on savings accounts are usually modest, but they provide a secure place to store money for short-term goals, such as emergencies or upcoming expenses. In short, saving money is important, but alone, it's not enough. Investing is also important to secure your financial future and reach your goals. Without the investment, you will not be able to make your money grow, and in the long term, your savings will be worth less due to inflation.